Welcome back to Turning Hard Times to Good Times. I'm really happy to tell you that Kevin Duffy is with me once again. He is he's had a very good career in the past. He's done extremely well with the Bearing Core Fund. It's a contrarian macro themed hedge fund with a flexible mandate, and they did extremely well during the 2008-2009 financial crisis. He has had a very good career. He had a little trouble making money a few years after I guess he liked the bad times. He made more money in the bad times. But then he said, how am I going to make money when times are good? And he learned how to do that too, which is why I'm really happy to have him here. The coffee can portfolio that Kevin that is in his newsletter, and I guess he manages it for himself, maybe for some other people too. I'm not sure. He can tell us about that. But he just sent me a note and actually updated the performance so far since the inception of the newsletter, the Coffee Can Portfolio. That goes back January, I think, 2020 sometime. It's up 55.97%. That compares to the S&P during that time of 20.86%. So those of you, you might want to perk up your ears and listen to what Kevin has to say if he can do that. If he can beat the S&P by that amount, you might want to pay attention. Very few hedge funds are doing that these days. So, Kevin, thank you so much for joining me.
Yeah, hi, Jay. Thanks for having me back.
It's really good to have you. So your fund started exactly, I think, February 18th, 2020, I'm reading here.
That's right.
So that 55.97% gain is since that date, February 18th, 2020. At the same time, the S&P has gained 20.86%. Gold is up 15%, CPI up 15%. So gold has kept up slightly ahead of the CPI. Your portfolio has knocked the cover off the ball against gold, against the CPI, and against the S&P 500, and global equities managed a small gain of about 5%. So here's the question, Kevin. We'll start off with this, and I know we have a lot more to talk about, but regarding your performance now, as I said, you did extremely well. I mean, you had like a triple-digit gain in 2008, 2009, and then you had a little trouble figuring out how to make money when times got good. Was there a change in your investment philosophy that allowed you to turn things around and do so well in all market environments? Hopefully you'll do well in this one.
There was a major change, and the change came from making really a pretty big mistake, and that was basically sticking with the program that worked so well in the past, and really not adapting and changing with the new environment. And I think finally, we went through this decade of ZIRP, markets just continuing to go up, and essentially we made money shorting the credit bubble, and we were very skeptical that all of the money that was being poured into the market, easy credit, would be successul, and so we essentially stayed short, and that was a disaster, and so. I think it was. It's hard to say exactly when I kind of hit bottom, but I really did, and I realized I needed to kind of just take everything down to the foundation, start over, and figure out what I was doing right, what I was doing wrong, and so there were a bunch of lessons that I learned from that, and probably rules, and I applied those to really going forward and completely changing my approach.
Mm-hmm.
So,
well, as I understand it, you believe in the Austrian School of Economics. You still do, probably, but the real world doesn't run on Austrian economics. It runs on Keynesian economics. And so was that part of it, was to say, well, I believe there's the ideal, there's the model that I think the way the world should be, but here's the way it really is, and I've got to live in the world as it really is, rather than one that I think should be.
I think that's part of it, but I had to be careful not to throw the baby out with the bathwater. I felt like the Austrian lens, the non-interventionist lens, was appropriate, and I think the problem Well, there were several lessons and several problems that I had to deal with. One is that as a short seller, you're really putting yourself in a position to get wiped out.
Mm-hmm.
And so the first lesson in all this is your number one goal is survival. I mean,
Mm-hmm.
never forget that. That's the number one goal. And and so you really have to be thinking about asymmetric bets. And this is why venture capitalists do so well. They have a lot of losing bets, but they have one big one that is a monster home run and makes up for all the other ones.
Mm-hmm.
If you're a short seller, it works the other way around. If you
Mm-hmm.
make one really bad bet, it can wipe you out.
Right.
So I
Right.
think that was really the first lesson that I had to learn, is that it's okay to be bearish, it's okay to hedge and that sort of thing, but you really have to be very careful about it and have very tight risk controls. I think the other thing is, and this is a danger with Austrian economics, is not to get overly dogmatic,
Mm-hmm.
that you have to have balance. You can't just focus on all of the negatives because they're very visible. The negatives from government intervention are visible.
Mm-hmm.
And it's the things that are not so visible, the things that are hidden, tend to be longer term secular trends that are positive. And so I think that was the second lesson that I took from all this, was you have to have balance in your life. You can't get too overly dogmatic. You have to cross-pollinate, be able to even people that you disagree with, sometimes they're going to be right. And
Mm-hmm.
so you have to have more of an open mind.
Mm-hmm.
I think that was a big lesson. And then and part of that is having multiple tools in your toolbox. So when all you're focused on is being a short seller and all the negatives, it's the old idea of when all you have is a hammer, everything is a nail. So
Right.
you lose your objectivity, I think, that
Mm-hmm.
way. You're constantly waiting for the next and praying for the next bear market, and there's so much more going on than just all the negatives. There are multiple threads playing together into this future that's unfolding. And I think it's just a lot more interesting world and a realistic world than just focusing on all the negatives.
Mm-hmm. I think that served you very well, and I think I probably have learned some of the same lessons to a certain extent. You mentioned venture capitalists. You and I both know Chen Lin, and he certainly thrives on that. It seems everything that I pick up that Chen wants to buy, though, doesn't work out. But he'll have he'll have a couple of them that are 100 baggers or whatever that get him over the finish. He's done extremely well. So yeah. Anyway, all right. Well, let's get on to your view of 2023. You sent a note to me. You said we might want to discuss the everything bubble, which phase we're in right now and where we're likely headed. So maybe we'll start with that. I mean, here you are. You're recognizing, as you say, the Austrian school people that understand it can easily see the problems with government intervention. I think that the Keynesians don't see those problems, or at least they don't want to. Maybe they don't want to see them because they're doing just fine with this program. But where are we now in this everything bubble? You're calling this, is this the bubble, the mother of all bubbles? Is that what you're referring to here? Something really big?
Yeah, I think it is. I think it's the greatest bubble that the world has ever seen. I don't think that's really an exaggeration. And bubbles go through phases. Obviously, they go through a long, slow buildup, and then they go through this parabolic rise. And they go from skepticism
Mm-hmm.
to optimism to euphoria. And when you go through that parabolic rise, you're at the euphoria part. And bubbles are collective detachments from reality. That's what they
Mm-hmm.
are. And
Mm-hmm.
you get that euphoric burst at the end of them, and you get a lot of backward look. All the people that didn't see this happening now are rationalizing why it happened, why it will continue, why it's different this time, and then you get the peak, and you start as things start to roll over. You go into denial, and then that passes through to fear, and then capitulation, and then finally despair, which is basically hitting rock bottom, kind of like what I went through personally, is you hit rock bottom and you actually change behavior. So I believe that we're probably in somewhere in the denial phase. Maybe in some cases we've reached levels of fear. We're in that, but I don't think that we've gotten into the capitulation phase yet. There are just a lot of examples of this. You see cash levels at Schwab and cash levels at Robinhood still have not gone up a whole heck of a lot. You have the government passing $1.7 trillion omnibus spending bills full of pork. They haven't gotten the memo yet that we're in a different world. So I think there's still a lot of denial. You see it in the technology space with companies that have been able to basically burn cash and spend lots of money on R&D and on marketing expense. And you haven't seen the wholesale cuts yet, but you're starting to get a glimpse of that. You're starting to get the layoffs at the big tech companies. And so, I think we're starting to move into that fear phase. And we've seen, again, trying to get some balance here. It's not all black and white. It's not like, oh, well, we're exactly here. You have different parts of the market. And you've had, like last year, IPOs generated less than $8 billion. That was down 95% from 2021. So there have been some definitely moves in the right direction. We're moving in the right direction. I think that's important to note.
Well, yeah, as I look at the markets right now, actually, Kevin, I mean, we're looking at the Dow. Well, we're looking at NASDAQ. It's up almost 0.75 of a point. I'm looking at the chart you sent along. There's a return to normal idea that there's a denial, then there's like a bull trap. Like people say, oh well, maybe it's it's just I don't really believe this is anything serious, just a tiny correction. Then you go back up and people start to feel like, well, maybe it's over, and then you get the really big drop, and then the bottom falls out at some point in time. Yeah, these capitulation things I've seen in the past, and it's when if you say, I can remember feeling this way myself. People tell you to go out and buy stocks. They're cheap now. You just saw the blood in the streets and you're saying, are you kidding me? I'm not going to buy any stocks. Never want to know. I never want to see a stock again. That's when you get capitulation, right? We've seen that in the past. We're nowhere near that. We're nowhere near that right now.
No, I don't think we are, Jay. And I mean, you and I we both experienced the '87 crash.
Yeah.
That was capitulation.
Yeah.
We saw what it was like in 2008. And today, just as an example, the Wilshire 5000 as a percentage of GDP, it got up as high as 200%. We're now at 148%. Well, the peak in 2000, the top of the tech bubble, was 143%. So we're actually higher than that level in 2000. But I think there's another thing. So there's another lesson here, or another rule that I use, coffee can rule number 8, which is it's a market of stocks, not a stock market. And I think it's important not to get too wrapped up in, the market is here and we're here in the cycle, because bubbles spawn anti-bubbles. And so there's always something going on, especially in a bubble. People forget that in March of 2000, when the NASDAQ peaked at over 5,000, a lot of these old economy value stocks actually troughed at exactly the same time. So it was these things are mirror images. And so I think we have to, keep that in mind as well, not just say, well, okay, we're here in the cycle, we're going to go to 100% cash. I don't think it's that simple.
All right, well, let's go to some of the ideas that you have, predictions, or at least these are views that you're taking right now. The first one, the economy comes in for a hard landing. So you see, I guess this is what you've been saying, we're nowhere near that. We're going to see the bottom fall out. I mean, the tech stocks, those kinds of companies that don't have any earnings, that thrive on zero interest rates, they've already gotten clocked pretty hard. Do you think they still have further to go?
I think you just have to take it on a case-by-case
Yeah,
basis. And,
right.
if I look at a stock like maybe Microsoft or
Uh-huh.
Apple, it
Hmm.
seems to me like these stocks have further to go. You look at some of these money-losing tech stocks, some of them will be able to cut their marketing expenses and their R&D expenses. And some of this is just they appear to be money-losing, but, if you really look behind the accounting, uh, those the marketing expense is really acquiring customers. And if
Uh-huh.
you have a software business and those customers are around for 10 or 20 years and you're running that through your income statement, then it's not giving you a real good indication of the profitability. But there are going to be I think there's still a lot of sort of zombies out there
Hmm.
that need to be taken out and shot. And we're moving through that process, but I don't think we're there yet. And there's still pockets of extreme overvaluation. I think when you look at the passive bubble and a company like BlackRock or some of these other companies that are kind of wrapped up in ESG ratings, they still have very high multiples, like 20, 30 times earnings or more. So there are pockets out there, but at the same time, there are a lot of cheap stocks as well.
Yeah, and that's what you focus on in your letter. You always have some very interesting ideas there. Um, Active management outperforms passive management. I guess that goes along with the idea that it's a market of stocks, not a stock market.
Yeah, and I think for me, the statistic there that I like to bring out is that we've had over the past 5 years roughly $1.5 trillion flow out of actively managed funds into passively managed funds, and of
Hmm.
course, a lot of that money is going into the S&P 500. So that is one of my themes. Is that I think that a lot of the risk right now is in the S&P 500 types of stocks.
Hmm.
I mentioned Apple, Microsoft. Still a lot of these big tech stocks seem to be. That's where the pockets of overvaluation are, and I think the opportunities are looking across the index divide. Companies that are not in the S&P 500, and companies that have a higher insider ownership. So the indexes are float weighted, which means that if you have low insider ownership, you're more likely to make it into the popular indexes. So I just think that this is where people have been. It's Let's put it this way. Last year, the whole idea of autopilot investing, it kind of hit an iceberg.
Hmm.
And, so it was the 60-40 portfolio did not work. The S&P 500 did not work last year. And I think that will continue. I think that the autopilot, that whole mindset that this is a simple game, it's an easy game, and just put your money into an index fund or the 60-40 portfolio, I don't think that's going to work moving forward for a while. Could be
No,
10 years.
we're gonna have to work a little harder, and I'm gonna have to work a little harder to cover all the topics. My engineer tells me we only have 3 minutes left here, so we got to get going.
Okay.
Gold regains its luster. You're suggesting. What do you see? Why gold in 2023?
Yeah, well, gold had a pretty rough 2 years, and it was interesting. August of 2020, it had a nice run, but peaked at a little over $2,000 an ounce, and at the time, year over year CPI was about 1%, and
Right.
then it goes to the 40-year highs over 8 or 9%, and gold goes nowhere. It actually goes down, and I think this shows just how strange markets and confounding they can be, and I feel like wouldn't it be interesting if we see CPI numbers come down and could come down quite dramatically in a recession, and that gold becomes a safe haven, and it could actually do just as it did not do well when the CPI went from plus 1% to plus 8%. If it were to go back down to plus 5 or plus 4, I think it could actually do well, and I think part of that has to do with the dollar as well. That's another part of the story where I just feel like the dollar has peaked, and a weak dollar is going to be gold bullish.
And with regard to the bond market, you see maybe a respite here in the short term, but likely higher interest rates, I guess, long term.
Well, yeah, definitely. I feel like the bond market, we had basically a 40-year bull market in bonds. That peaked with something like $18 trillion of negatively yielding bonds around the world. And that, we're now going into a long bear market. And bonds tend to go through these really long bull and bear markets. So I think this could be a decades-long bear market. However, at least with the U.S. Treasuries, the bullish consensus got down to 21% bulls, which is the lowest it's been in a very, very long time. And so it would not surprise me that, especially if we get a deeper recession than people think, that bonds get a little bit of that safe haven status and there's a bit of a bounce back. But I think it would be a rally in a secular bear market.
Okay, we're going to have to leave it go at that. Kevin, I'm so sorry. We got to have to back again to talk more because there's so many things I want to hear from you. But where can people go to sign up for the Coffee Can portfolio?
Go to either do a Google search on the Coffee Can portfolio or just go to thecoffeecanportfolio.com.
All right, excellent. All right, very good. Thank you so much, Kevin. Sorry, we're out of time. Gotta go.
Okay.
We'll have you again sometime soon.